Hey guys, Toby Mathis with Infinity Investing, and today we're going to be talking about how to find top dividend-paying stocks. Let's do the 10,000-foot view. You oftentimes hear me saying that because I want to look down at the entire realm of the stock market, and then we'll start narrowing our focus so you understand why it is that we zero in on particular companies and not others. So first off, you should understand what a dividend is. If you are a corporation, C Corp, you're paying your own taxes, and you take whatever it is that is the profit and I decide to distribute it out to my shareholders, that is a dividend. That's a typical dividend. If I'm paying monies out to my shareholders, that would be considered a dividend. Now, the beautiful part for a recipient of dividends on the US stock market, companies that are US based, is that they are taxed as long-term capital gains. So I like it from a tax attorney standpoint because you're going to pay a maximum of 20% federal tax. Now, if you're over a threshold, if you're in that 20%, you're also going to get hit with the net investment income tax, which is 3.8. So the max federal tax on your dividends would be 23.8. Now, if you're in a Roth IRA, traditional IRA, 401k, you're not going to be paying anything. Or if you are married filing jointly, making less than, say, $80,000, you're in the 0% long-term capital gains bracket, you're not paying tax either. So it's going to be 0, 15, or 20%. So we love that. So the companies are paying out their profits to you. And the way I always look at it is kind of like this here. I'll just draw it up here. But let's say I have ABC. And they have $1 billion sitting in it. And so their value of their stock is going to be it's going to be basically all the stock outlying divided into whatever their assets are. But let's just say we'll just use a super simple. Let's say that there was 1 billion shares, then the shares would be worth $1 billion, right? If that's all the assets. We're looking at assets minus liabilities plus shareholder equity. So if I'm using typical balance sheet, I can actually get a valuation. This is super simple. You don't actually do this. But let's just say I had 1 billion shareholders and they all owned a share in the equity. Shareholder equity was $1 billion. That means each share is worth $1 a share. The reason I'm bringing this up is because if they paid out half of that, let's say they paid out 50% to the shareholders, what does it do to the share price? It cuts it by 50 cents, but you have 50 cents. You still have the value, but it's moving it out. The reason I bring this up is because the companies like Amazon, a lot of the tech companies that are growing and they hoard their cash and they're not paying it out to the shareholders, that's why they get these huge valuations. They're just growing and growing and growing because they don't ever pay out. On the same token, there are companies like if I use Walmart and Amazon, Walmart pays out a dividend every year. And that comes out of that little bucket and goes out to the shareholders. You have to ask yourself as an investor, do I want to just kiss my money goodbye, buy money, put it into a company and hope that that company goes up? That's called a growth stock. Or do I want to put my money in and say, money, I'd like to see you back soon. Let's start having some of that coming back right away. And they immediately start kicking you out the dividend. In my world, it's not even a question. I want the dividend. The reason I want the dividend is because A, it's tax beneficial. B, it's because I want the cash flow. I don't want to just give a no interest loan to a company and go like this. Oh, I hope it goes up. I hope it goes up. Oh, please go up. They may be taking all your money offshore anyway. You may never see it again anyway. So, oh yeah, sure, we'll pay you back. Oh, there's all these people going, oh, there's value. You know what's value? Being able to spend something and be able to buy groceries with it. I want the dividend. So it's not even a question. If I have to choose between growth stocks and dividend stocks, I'm picking dividend stocks because I want the cash flow, because I can live off of it. If I want to retire, I can't retire on the hope and prayer that something goes up. Or if something does go up, I can't retire on it without selling it. Maybe I could borrow against it, but then I'm paying interest on it too. It's like, wait, I gave you money, now I'm borrowing on my own money, but I'm paying interest back? Let that one sink in for a little while, right? So I want the dividends because I can spend the dividends. So I like dividends. So that's number one. But the company does need to be profitable. It needs to be a successful company. Well, how do I know what a profitable company is? Well, here you look at it. You look at their P&L, you look at their balance sheet, and you need to see a history. I will not touch a dividend company. I'll just call this a dividend company. Pretend that you could actually read that. That says dividend. The dividend stocks, I want a company that has a track record of at least 10 years. At least 10 years. And I want a good return on my money. If I invest it, you'll see this thing called dividend yield, looking at a forward 12 months or a trailing 12 months. You'll see TTM. Yeah, but I want a dividend yield based off of what is projected to be its profitability and what percentage of my investment I'm going to get back. So for example, I could invest in AT&T, which company is just, it's not, the stock price has just been flat, if not down a little bit, but I'm getting a 7% dividend, which means I give it $1, it's going to give me back 7 cents a year until I've got my dollar. Like it'll only take me, what would that be? About 10 years before I got all my money back. Then I own the company free and clear. Yay! I don't have any money invested. I've gotten it all back, right? Even though I own the shares worth X, I've gotten all my money back. That's a high yield dividend stock. Generally speaking, most companies aren't paying a 7% yield. People may be attracted to that 7% yield, but then we would say, time out. We need to look at other factors. A, we want to see a history of raising that dividend. I do not want a company that's teasing me, that's throwing money out there to get investors to put money in. In other words, they're giving out 110% of their profit from last year as a dividend. Think about that for a second. So they've had some good years. They're starting to suffer. Their stock price starts going down. The management gets together and says, we're going to do a special dividend. We're going to pay out way more than what we made last year to try to attract some more investors. So people like us because we're going to have a high yield. All of a sudden, we're going to have like this ridiculously, maybe they'll have a 10% dividend yield. And everybody goes, oh my God, I'll make 10% of my money, except they only did it once. They're doing this. Come on in here. Come on in here. Don't do that. You want historical returns that they consistently do. And you're going to look at something called free cash flow. So we want to make sure it's not hurting them. So for example, if they had the $1 billion and they paid out 50% of it, you're probably okay. You're saying, hey, they paid all their bills. They have $1 billion sitting in the bank. We know what inflation's doing. It's not a good place for it. So give it out to the shareholders. Okay. Are they going to hurt themselves in any way? Do they have any other capital needs? Consistently, they make $1 billion a year. Does it bother me that they're paying 50 cents out on the dollar and that they're only keeping 50 cents in the dollar for growth? To continue to reinvest and do other things. No, it's not really going to bother me. That's free cash flow. If you see a company paying out most of its free cash flow to its shareholders, you got to be timing out and saying, hold on for a second. I need to really look at that company and say, is this something that's going to be able to continue? Maybe if it's a real estate, they're required to. So they're paying out a REIT, but that's a little bit of a different animal. They may be required to pay out their revenue. And they're like, hey, I have to pay out 90%. Right? But everybody else, no, they're not required to. So you're looking at it. Maybe there's a utility or something that has, they're going to get that revenue no matter what. They don't have to worry about their market. But if it's a tech company or something like that, I'm looking at it going, I need to see that revenue because they need to continue to expand to be competitive in the marketplace. And maybe they're in a really competitive marketplace versus something where somebody's been there for 50, 60 years already. And I'm not too worried about it. Like, hey, they already have their marketplace. They're a behemoth. They're making money hand over fist. They're always profitable, and they're paying out, a portion of their, maybe the 30% of free cash flow every year, and they're using the rest to continue to grow. That's a great situation, and that's what I'm focusing on. So how do I find them? It's actually really easy. You go to infinityinvesting.com, and we have a list, right? We actually rate them constantly, and we're looking at companies that have been profitable at least 10 years, although I'd caution you even that. I say least. I like looking at 25. It's called a dividend aristocrat. They actually have a list, $1 billion in market valuation, 25 years of increasing its dividends. So like if I gave you $1 last year, it's $1.10, it's $1.20, it's $1.30. Every year it goes up. So I may be looking at the dividend yield today, but that yield is actually rising. It's going faster than inflation. That's what I like. I actually look at that dividend yield and I look at its historical return and say, I want to see it increasing. But I love to see it increasing 15%. because my money is growing at a much faster rate. If your head just popped, just keep it simple. I'm looking at companies that continue to get more and more profitable. They're great companies. They're rewarding the shareholders, and it's just continuing to grow. And I don't have to worry about a downturn. I don't have to worry about it. Like, hey, stock market crashes. In 2008, market crash, right? 38%. Dividend kings, companies that were actually 50 years or more paying out increasing dividends, they went down 18% versus 38%. And then they've tripled the return of the S&P over the next 15 years after that. Or not even 15 years, excuse me, about 10 years. It was a period of time after that. So ever somebody always goes and says, it's about growth stocks, that's what you want to do, blah, 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 blah. I'm always looking at them going, hold on for a second. It's not about, hey, I planted a seed and I'm going to harvest it when it's a full tree. That doesn't cut it for me. No pun intended. If I am going to plant a tree, I want the fruit all throughout the years. I want to continue to be able to harvest and the tree to grow. That's what I'm looking for. So it's very, very few companies once you start looking at it. I'd encourage you to look at only companies that have 2% or greater dividend yield. I want to see a history of paying out dividends. It's tough in this day and age. You're going to make the market really small. We're talking about less than 30 candidates that you're going to look at seriously. And now you can get to know them and say, where's the opportunity? Where's the value? Where's the thing that I'm missing? And you can grab it. And so I'd encourage you to come into Infinity Investing and look at that sheet. If nothing else, it's free, but you get in there and you take a look at these things and it starts to change the way you view the market. It makes it very, very small, very, very quickly. All right, so if you like this type of information, I'm going to ask you to do two things. Number one, subscribe to the channel. Number two, like the video. Now, third one is really up to you. Share it with somebody that you think could get a benefit from this information. And if you are willing to spend the time, please give a comment and let us know what other topics you want us to hit. There's a lot of bad information out there, and we love coming in with uppercuts and knocking it out of the park and saying, here's the actual truth of it. What they're trying to get you to do is activity where you make your money is on inactivity, but buying assets that pay you instead of just giving money away to the elites to sit on and do as they please. And then you may or may not get something back in return.